Hey, what's up everyone? In today's video I'm going to be breaking down my swing trading strategy, which surprisingly can be used as a day trading strategy as well. I'll get to that in the end of the video. But before we get to the video, check the link in the description for the full course and get 50% off if you use the top link. As you may know, I break down my strategies into three main parts, which are the trading bias, the trade setup, and the trade entry, which is the confirmation. And the trading bias, as you may know, just has to do with what direction is price going at the current moment. So you know what kind of setups to look for, whether it's a sell setup or buy setup. And in this case, the trade setups are what you see here, which is a W setup and M setups. I'll get to that later. Let's start with trading bias. As explained in the previous video, my trading bias has to do with market structure with the strategy. Strictly market structure. Or sometimes you can use the EMAs, which I'll explain again in the previous video. The 10 exponential moving average and the 20 exponential moving average. You can use them in a way, but I want you to be looking at the market structure. And to explain it again briefly, for the market structure, for downtrend, we look for both lower lows and lower highs. And for uptrends, we look for both higher lows and higher highs. Okay. If you still don't understand, you can check out the previous video. And next up we have the trade setup. And just as I just explained, our trade setups are the W setup and the M setup. To explain briefly, the W setup happens when price comes down, goes up to form a neckline or the neck point, then comes back down, then goes up to break the neck point. See, price broke the neck point right here to form a W. The M setup now has to do with the complete opposite, where price goes up, comes down to form the neck point, goes up again, then comes down to break that neck point right here. And if price does not break these neck points, it's not an M or W. It's only an M or W once price break the neck points. So let's get rid of these. Got rid of something that they want to get rid of. Okay. Let's draw that up back. Okay. So let's look for some examples of W and M setups on the real charts. We're on the daily time frame right now. So let's look for some. Okay, price is coming down right here. So once price is coming down and we're looking for M's and W's, first we wait for price to come down to form a lower low. So we know price is going down. Price from a lower low comes up from a lower high and then continue going down. So for our W formation, like what we had up there, as you can see, price came down. Let's draw this up. Price came down here for our first W formation right here. Price came down, went up, came down again, and went up to form a W, which broke this neckline right here slightly. Neck point right here. then continue going down. So our trade would be on this movement going down right here. Let's create all these. That's an example of a W formation or W setup. Let's look for another W setup somewhere. Okay. Kind of got one right here where price came down, came up, came down, then came up to break above this neckline right here, neck point, before it dropped down again. And the downward move would have been our trade in this case. Let's look for another one. Oh, there's a good one right here. As you can see, price came down, came up, a very small W, came down again, then went up, broke this neck point before it dropped down. Formed the W formation right here. See? See, this W formation. Now let's look for M formations now. Look for M formations. Okay, once price broke below here, formed this lower low, there was an M formation right here. Price went up, came down to form the neck point, went up again, then dropped right here to form an M setup right here. It's simple as that. Then we had another M formation, no M setup right here. As price went up here, dropped, came up a bit, then dropped to break below this neck point right here to form an M. Then we had another one again right here where price went up, came down, went up again, then came down to form an M. Okay, let's get rid of all these. And just to clarify, we look for these M's and W setups on the weekly time frame and the daily time frame. But for this video, we're going to be focusing on the weekly time frame. I just gave you examples on the daily time frame. Let's look for some examples on the weekly time frame. Okay, we have this big down move right here, this down trend right here. Let's look for some M's and W formations. So we can see here, price broke below, forming a lower low. So we expect a lower high again, then lower lows and lower highs for the downtrend move. Okay. Let's look for some W's and W formations. And as you can see here, we have some right here. So see, price came down here, went up, came down, then went up to form a W formation right here. And then we had another one right after that over here where price went down. Price went down here, came up, went down again, came up to form a W. Then we had a small one right here again where price went down, went up, went down again, then went up, which all these broke their neck point. And in this example right here, you can see there the W formation that we just marked out over here was actually in a bigger W formation. If you look closely, the price went down, up, went down again, then went up before dropping. Just over, up, down, up. form this W right here, which is a big W, which had smaller W's inside of it. Okay, let's get rid of these. And we actually had another example of a W setup right here. Price came down, a big one, a big W setup, went up, came down, then went up again to form a W before dropping. That's a big W setup right there, which actually has smaller W setup inside of it, where price came down here, went up, came down, then went up again before dropping. This is an example of a almost W setup, where price came down here, went up here, came down on this bearish engulfing candle right here before coming up again. But as you can see in this example here, this will be the neck point right here. And as you can see, price didn't break it until it came over here, which was the big W setup that we just pointed out right there. So this is an example right here of a almost W setup. We have another one right down here. The price came down, price went up, came down again, then went up before dropping. See, price broke the neck point right here before dropping. Now let's look for some M setups. Coming back to his top. What you may notice is that sometimes the W setups falls right in with M setups, or a leg of the W setup might be a leg of the M setups, and so on. But that's normal. Okay, let's look for M setups right here, right now. As you can see, we have one right here where price came up, went down, then came up again, then dropped, which broke this neck point right here, which was a form, which means that it's an M setup. As it broke the neckline. Other price had another smaller one right here. The price went up, came down, went up here with this small bullish candle before coming down again, which broke this neckline, which is an M setup. And then we have another one right over here, coming right after this W setup that we just pointed out just a while ago. We have this M setup. Price came up, dropped down, came up again before dropping for an M setup. Okay, and then we have another M setup right over here, which is kind of hard to see, but if you look closely, you can see this is a bearish candlestick right here with the long wicks. Let's mark it out. Because the price came up here, dropped, came up again, then dropped for an M setup, which broke the neckline. Okay, now let's talk about entries. Go back to the daily time frame. Let's talk about entries right now. For this strategy, even though we look for our trading setups on the weekly and daily time frame, we switch to the 4-hour time frame for our entries. And our entries is a bit more complicated than just looking for M's and W's. Like for example, for the W trading setups, we use both the 20 exponential moving average and the MACD, which is the moving average convergence divergence indicator, which I explained. I think I explained in a different video, not so sure. but it's this indicator right here. We use both of those for our entries, our entry confirmation for the W trade setups. We wait for the cross of the 10 exponential moving average and the 20 exponential moving average. Wait for both of them to cross. And also with that, we wait for the MACD line or the moving average convergence divergence line to cross below the 0 point on the MACD indicator. So like here, for example, the MACD line right here is the blue line in this case on TradingView. These are default settings. So the blue line here is the MACD line. We wait for this to cross below the 0 point, and the 0 point is right here. I'll mark it out a bit clearer, somewhere along here, as you can see. So we wait for the MACD line to cross below the 0 point, along with the 10 exponential moving average and 20 exponential moving average to cross, for us to look for a sell with the W trade setup. Okay, for the M trade setup now, it's a bit different, as now we use the Fibonacci tool, which is this tool, the Fibonacci retracement tool. We use it to find a point where price bounce off of, to look for our entry. You can check out my video on the Fibonacci tool if you haven't watched it, but it's basically this. Once price is going down and price already broke the neckline right here, as you can see, this will be a neckline on the M setup. Price broke the neckline, came down. We wait for price to retrace up back. So we draw our Fibonacci tool. Oh wait. We draw our Fibonacci tool from the high to the low before the retracement, and then we wait for the retracement to happen, so where price comes up back. It's a bit make it make more sense. Okay, we draw our Fibonacci tool from the high to the low, then we wait for price to come up to our 0.382 point or 0.5 or 0.618 point. Wait for price to come up, bounce off of them before dropping. And this is not the only confirmation that we look for. We also look at what price did before that. So for example, we look for any levels before that, any support levels or resistance levels before that, what that correlates with our Fibonacci points. Like for example, right here, we had two support areas right here. We had two support areas that correlates with the 0.382 point on the Fibonacci. So then we look for price to come up to this 0.382 point, and then we enter on our points, our which I call our bank points, which are the points that the major banks use, which are the 20 level, the 50 and the 80. So we look for 20, 50 or 80. We look for the closest one. So on this point, we're closer to the 50. We look close to the 50. So we look for the 50 point, which is right here. It correlates exactly with our 0.382 point on the Fibonacci. We look for that and we set a sell limit. we set the sell limit, and then when price comes up for retracement and hits that level, it will activate our sell, and then we place our stop loss. Let's draw it up here. We place our stop loss right a little bit above the 0.786 point on the Fibonacci, or for a better risk to reward ratio, we place it at a little bit above the 0.618 point on the Fibonacci. And coming up to our last point right here, which is 3.1, which is risk management. This will come after you already open the trade, all the trades are already running. We always aim for a 1 to 3 risk to reward ratio. Always. You can go for a 1 to 4 if you want, or 1 to 5. But make sure to at least go for a 1 to 3 risk to reward ratio. Or at least take off 75% of your trade at a 1 to 3 risk to reward ratio, and then leave the rest to run for however you want. Or in some cases, we can use the negative 0.272 point on the Fibonacci for our take profit. If it does not comes up to a 1 to 3 risk to reward ratio, we use our negative 0.618 point on the Fibonacci. Or you can just go for a simple 1 to 3 risk to reward, any one you want. Okay, now that we explained that, let's look for some examples. And in this video, I'm going to be looking for examples on the weekly time frame, because the daily time frame is a bit different. So I'm going to be explaining the weekly time frame in this video. I'll have a video on the daily time frame later on. Okay, so let's look for an example right here. Right over somewhere over here. Okay. As you can see, price is coming down. Sorry for yawning. Price is coming down. So let's look for M or W formation. And in this case now, okay. I'll go back here. Let's look at this. No, I want a W formation first. Let's look for a W formation. I'm not too sure if we can go all the way back here. So let's look for one a bit closer. Let's look for one a bit closer. Okay. Well, we can go all the way back here. Okay, let's look at this example right here. Let's look at this example. Let's start. Okay. If you look close, you can see the price. If you look close, you can see the price from the W. Price from the W formation right here. As you can see, price from the W. So the first thing we need to know is to identify the neckline or the neck point, and which is very hard to do on the very hard to do with candlesticks. So we normally switch to the line chart, as you can see, then mark out the neckline. Let's bring this thinner. Okay, mark out the neckline. Then we adjust it to one of our points, one of our bank points. In this case right here, since it falls on this price, we go to the closest one above. So we'll go to 20. If it was at 26, we'll go for 50. Or if it was at 30, we'll go for 50. And if it was at 60, we'll go to 80, and so on. But we'll go to the 20 point right here. Let's switch back to the candlesticks. And let's mark it out with a rectangle, so we know where to go back. Let's mark out the candlestick that broke the neckline as well, so we don't get confused once we switch to a lower time frame. Now let's go to the 4 and see if we can go all the way back there. With the 4. Not too sure. Okay, we made it. We got it. We luckily got back there. Okay, let's get rid of this vertical line. Okay, so we know price broke above the neckline somewhere around here. And if you remember from what I just said, when we have W formations, we use the MACD and the exponential moving averages for our entries. So let's pop out the MACD. And price broke it somewhere around here, broke the neckline somewhere around here. And our bias is to sell, so we're looking for sells here. So price is going up. We look for two things. We look for the cross of the 20, right here. The 20 is the red moving average, cross of the 20 and the 10. We look for the 20 moving average to be above the 10 moving average, which is the red to be above the blue for a sell. Which you should remember because red over blue, red is normally indicating sell, just like the candlesticks, and so on. So we wait for the red to cross above the blue, and we wait for the MACD line to cross below the MACD, which is the blue line, to cross below the 0 point. Wait for both of these to happen at once before we take our entry. And it happens somewhere along. As you can see, price on the MACD, price hovered above the 0 point for a pretty long time, and then it crossed below right over here on this part, on this candlestick right here. Zoom in a bit. Cross below on this candlestick, and as you can see, the 20 exponential moving average is over the 10 exponential moving average. So we're looking for our sell entry. So our sell entry will happen right on this candlestick. So we pop out our trade. We enter at the close of the candlestick, which is right here. Stop loss above the previous high or previous level, previous resistance. We put our stop loss above a previous level, which in this case is right here, above this this wick, which is 62 pips stop loss, and we go for a 1 to 3 risk to reward ratio. And in our case right here on W setups, once we're using the weekly time frame for our chart setup, and we have a W formation or W setup, we make sure that the point that we enter the trade and the neckline is between the neckline and the point that we enter the trade. We make sure that it's at least a 1-to-1 risk to reward ratio. At least a 1-to-1. If it's not a 1-to-1 risk to reward ratio, it's less than a 1-to-1, we do not take the trade. If it's a 1-to-1 risk to reward ratio and above, we take the trade, and we take it for a 1-to-3 risk to reward ratio at least. It's a bit different for the no, it's a bit different if we look for a setup on the daily time frame, but on the weekly time frame we make sure that it's at least a 1-to-1 risk to reward ratio. And as you can see, price went down and got to our take profit right over here. Price got to our take profit. So on this trade we would have made 189 pips profit. In our next video we'll be going over the buy setups instead of the sells, which is basically the same, but I'll just go over it just for those who are a bit confused on how to look for the M and W setups on an uptrend. So that brings us to the end of this video. Hope you understand. If you don't understand, make sure to get in contact with me. Ask me any questions you want. Leave a comment or anything, and I'm out. See you on the next one.